Stocks did close sharply lower today, but it was the bond market that was in the driver's seat. The yield on the 10-year benchmark Treasury fell to a 19-month low today to under 2.3%. Investors are growing more convinced that the trade war with China will last longer and that economic growth could suffer as a result. And so, while they were embracing the safety of bonds, investors were reducing risk by selling stocks today. And by the close, the industrial average was down 237 points. That's about the low for the session. NASDAQ fell by 29. The S&P was down 23. Mike Santoli starts us off tonight from the New York Stock Exchange.
The stock market has held on to most of its gains for the year during a turbulent month of May. But over the past year, bonds have been better to investors, thanks in part to the trade war that has unsettled equities. The drop in the 10-year Treasury yield today to a 19-month low under 2.3% highlighted the powerful gain in bond prices, which move in the opposite direction from their yields. This bid for safe assets reflects worries over the global growth outlook, which have grown more urgent with the U.S.-China stalemate on trade rules and tariffs. Persistently low inflation has also encouraged a move into bonds, and the return of government bonds in Germany and Japan to deeply negative yields has likewise dragged Treasury and U.S. corporate debt yields lower. As a result, the total return for the Barclays Aggregate Bond Index, which captures all government and private sector debt, has been about 6% over the past 12 months, a fraction better than the return of the S&P 500 index over that time, including dividends. The bonds have delivered that return with far less volatility than stocks, which suffered a quick 20% loss at the end of 2018. What's more, it's the part of the stock market that acts most like bonds, dividend-focused utilities and real estate, that have done best to hold up the broad indexes lately. Of course, over longer stretches of time, stocks have handily outperformed bonds, as finance theory says they should. Over the past 3 years, as a matter of fact, the S&P has returned more than 12% annually, compared to about 2% a year for bonds. In this way, bonds have again done their job in diversified portfolios by adding stability in times of stock market weakness and holding most of their value when stocks are doing well. The question from here is whether the bond market can continue its impressive performance. Right now, short-term treasuries are strongly pricing in a Federal Reserve rate cut or two in coming months, which presumably would require the economy to lose more steam in a way that stock investors might not like. This means that any receleration of the economy or unexpected resolution of the trade war could test the strength of bonds and perhaps refresh investors' interest in stocks. For Nightly Business Report, I'm Mike Santoli.